Most retirees overpay taxes by tens of thousands every single year. Today, I'll show you 7 little-known strategies that could multiply your retirement wealth by 5 times, legally. And almost nobody uses number 4. Even financial advisors ignore it. You've spent decades grinding, saving, and sacrificing to build a nest egg. But there is a silent predator waiting for you at the finish line. That predator is the Internal Revenue Service. Without a proactive plan, you might find that the government becomes the primary beneficiary of your hard work. We are going to change that today. We aren't just talking about small changes, we are talking about a total wealth optimization overhaul that ensures you keep what is yours. The biggest lie we've been told is that taxes naturally go down when you stop working. Many people believe that once the paycheck stops, the tax bill vanishes. This is often completely false. In fact, for many high achievers, retirement can actually be a higher tax environment than their working years. You are walking into a minefield of required minimum withdrawals, Social Security taxation, and hidden tax brackets that can strip away 30 or 40% of your purchasing power instantly. You don't realize the damage of these systemic leaks until it's far too late to fix them. But there's a way to legally avoid most of this if you know how to navigate the system. Let's dive into strategy number 1. Tax bracket arbitrage. Most people think the goal of retirement tax planning is to stay in the lowest tax bracket possible, like the 10% or 12% range. But that is actually a mistake. The real goal is to fill those low brackets completely. You don't want to stay in the lowest bracket, you want to maximize it. Think of tax brackets like empty buckets. If you don't fill the 10% or 12% buckets this year, you lose that space forever. By strategically withdrawing just enough from your traditional IRA or 401k to reach the top of a lower bracket, even if you don't need the cash right now, you prevent yourself from being forced into a 22%, 24%, or 32% bracket later in life. This proactive filling of brackets ensures you are paying the lowest possible rate on every dollar over the long haul. This alone can save you 6 figures, but it gets better. This leads us directly into strategy number 2, the Roth conversion ladder. This is the holy grail of tax-free growth. Most people have the bulk of their money in tax-deferred accounts, where every dollar taken out is taxed as ordinary income. A Roth conversion allows you to move money from those tax-deferred accounts into a Roth account, where it grows and is withdrawn totally tax-free. The trick is to do this in small chunks during your gap years, that sweet spot between the day you retire and the day you are forced to take government-mandated withdrawals. By converting small amounts over time, you control your tax bill today to avoid massive, uncontrollable taxes later. You are essentially choosing to pay a small toll now to avoid a massive tax wall later. But timing this wrong can actually cost you more if you accidentally bump yourself into a higher Medicare premium tier, so precision is key here. Strategy number 3 is something very few people realize even exists: the 0% capital gains window. This is a massive loophole for anyone with a brokerage account. If your taxable income falls below a certain threshold, which is quite generous for married couples, the tax rate on long-term capital gains drops to exactly 0. You can sell stocks, ETFs, or mutual funds that have appreciated significantly and pay absolutely nothing in federal taxes on the profit. Most retirees don't even know this bracket exists, so they settle for paying 15% or 20% on their gains. By strategically harvesting these gains during your low-income years, you can reset your cost basis for free. It's like getting a reset button on your investments without the tax penalty. This is pure wealth optimization at its finest. We've covered 3 powerful strategies already that can save you a fortune. We've looked at how to fill your brackets, how to convert to tax-free accounts, and how to pay 0 on your investment growth. But the next one is the most powerful and the most ignored. This is the strategy that changes the entire trajectory of your net worth. Strategy number 4 is delaying Social Security. Now, most people look at Social Security as just a monthly check, but it is actually a high-level tax strategy. For every year you delay taking Social Security past your full retirement age, your benefit increases by about 8%. That is a guaranteed inflation-adjusted return that you can't find anywhere else. But here's the tax secret. By delaying those payments, you are forced to live off your traditional IRA or 401k balances earlier. This reduces the size of those accounts, which in turn reduces your future required minimum distributions. Smaller future withdrawals mean lower future tax brackets. This decision alone can change your entire tax picture by reducing the tax torpedo effect, where your Social Security benefits become up to 85% taxable because your other income is too high. By delaying, you create a shield for your future self. Strategy number 5 is tax diversification. You have probably heard of investment diversification, but tax diversification is just as important. You need to have a mix of 3 distinct tax buckets: taxable, tax-deferred, and tax-free accounts. Think of it like having 3 different valves on a sink. If you only have a traditional IRA, you only have one valve, and the government controls the pressure. If you have a Roth IRA, a standard brokerage account, and a 401k, you have flexibility. This flexibility equals control, and control equals lower taxes. If you need a large sum of money for a new car or a vacation, you can pull from the Roth or the brokerage account to avoid triggering a higher tax bracket that year. Having these 3 buckets allows you to engineer your taxable income to stay exactly where you want it every single year. Strategy number 6 involves qualified charitable distributions, or QCDs. This is for the person who wants to give back while also keeping their money out of the hands of the IRS. If you are over the age of 70 and a half, you can donate money directly from your IRA to a qualified charity. This money never touches your bank account, which means it never counts as taxable income. This is far superior to taking the distribution and then claiming a deduction. By using a QCD, you lower your adjusted gross income, which can help you qualify for other tax breaks, and even lower your Medicare premiums. You give more to the causes you care about, and you lose less to taxes in the process. It is a rare win-win in the tax code that most people simply overlook because they are used to the old way of donating. Finally, strategy number 7 is the stealth tax avoidance. This is where retirees silently lose the most money without ever realizing it. We are talking about IRMAA, which stands for Income-Related Monthly Adjustment Amount. If your income crosses a certain threshold, even by $1, the government can hike your Medicare Part B and Part D premiums by thousands of dollars per year. It is essentially a hidden tax on high-income retirees. By using the withdrawal strategies we discussed earlier, like tax bracket arbitrage and tax diversification, you can stay just below these invisible thresholds. It's about being mindful of the cliffs in the tax code. One extra dollar of income doesn't just cost you 24 cents in taxes. It could cost you an extra $3,000 in healthcare premiums. Staying under these limits is the ultimate way to protect your cash flow in your later years. We have covered a lot of ground today, from maximizing your low tax brackets and building a Roth conversion ladder to utilizing the 0% capital gains rate. We looked at why delaying Social Security is a tax play, why you need 3 buckets of money, how to give charitably without the tax hit, and how to avoid the stealth taxes that ruin your monthly budget. You don't need to implement all 7 of these strategies to see a massive difference. Just 2 or 3 of these done right can change everything and potentially help you retire 5 times richer than the person who just follows the standard advice. The system is designed to reward those who plan and penalize those who don't. Retirement tax planning isn't a one-time event. It's a series of strategic moves that you make year after year. If you want a step-by-step retirement tax plan that goes even deeper into these numbers, you need to keep educating yourself on how these rules change. Your wealth is your responsibility, and the more you know, the less you owe. If you found this valuable, make sure to hit the like button and subscribe to check out our next video where we continue to show you how much you could save. Your future self will thank you for the work you are doing today. Stop overpaying and start building the legacy you actually deserve.